let's work through a stock dividend example problem. So this problem says Rogers Company has 200,000 shares of $5 par value common stock outstanding on January 1st, 2019. It also has $3 million of retained earnings. We need to prepare the journal entries for the following transactions. So on February 1st, Rogers Company declares a 10% stock dividend when the market price is $12, and then a few weeks later they issue that stock dividend on February 15th. So our journal entries, we have some calculations before we can even start thinking about how to journalize these transactions. The first thing is to figure out how many shares are we going to be handing out in this stock dividend. So what we do is we take the number of shares outstanding that we have, the 200,000, and we multiply it by 10% or by 0.10. And we'll see that that comes out to be 20,000. So in this stock dividend, we are handing out 20,000 shares. Now we can start the journal entry here for February 1st. Whenever you declare a stock dividend, you will debit the account stock dividends and you will credit common stock dividends distributable. Now let's figure out the numbers here. So for stock dividends, we take the number of shares that we just calculated, that 20,000, and we multiply it by the market price. So our market price here was $12. So 20,000 times 12 gets us 240,000. So we debit our stock dividends for 240,000. Now common stock dividends distributable. This one's going to be valued at par. So we take our 20,000 once again and we multiply it by our $5 par value. And we see that our common stock dividends distributable is 100,000. So we credit that account for 100,000. Now, your debits and credits don't equal. So we need to also credit the account paid in capital in excess of par common. Why are we doing this? Well, when we declared the stock dividend, the market price was greater than our par value, right? So we have this in excess of par amount. Now, a few different ways we can find this number. We need our debits and credits to equal, right? So we could just take our 240 minus 100 and toss in the number there for your paid in capital. But where does that come from? Well, it comes from taking your 20,000 shares times the difference between your market price and your par value. Because this is all about how far above par was the market price. So if we do 20,000 times 7, which we get by doing 12 minus 5, we get that $140,000. So that's for the declaration of a stock dividend. Now, when a company issues the stock dividend, we debit your common stock dividends distributable and we credit common stock. So we take it out of our distributable account and we credit common stock, showing that we are now issuing this amount. And we get the 100,000 by taking a look back at the common stock dividends distributable amount in our declaration journal entry.